I'm going to talk about bond investment opportunities that are present in the current phase of market cycle. The key driver for bond market outlook is that policy rate hike cycle is ending. Inflation, the main reason for aggressive policy rate hikes in the past of 1 year, is trending downwards. In addition, slowing economic growth will keep central banks away from further aggressive rate hikes. With aggressive rate hikes behind us, it is essential for investors to start positioning to capture bond investment opportunities for the upcoming phase of monetary policy rate normalization. This will start with policy rate pause and thereafter policy rate cuts. The chart shown here is the US policy rate cycles over the past 60 years. The 10-year US Treasury yields, the red line in this chart, has historically dipped just before policy rate pause. This is in line with lower economic growth and inflation. So we are now at the same juncture of US policy rate cycle, hence the positive outlook on bonds moving forward. We expect policy rates in key countries to pause soon and policy rate cut to start sometime in the fourth quarter of 2023 and first half of 2024, as displayed in this table. Anchored by expectation of policy rate normalization, we have recently turned overweight on bonds. We expect a bullish bond yield curve steepening to unravel between now till end of 2024, as the existing inverted yield curve is not sustainable over longer term. As shown in this chart, we believe the US Treasury yield curve will revert to an upward sloping shape similar to conditions at the end of 2018. Just before the previous cycle of policy rate pause. Moving forward, we expect short tenor bond yields to fall more than long tenor bond yields. In deriving this positive outlook on bonds, we have also considered and continuously monitor key risks on inflation resurgence, deep recession, and financial sector instability. So far, we have assessed that these key risks have low probability of actually occurring. It is essential for investors to capture bond investment opportunities as early as historically bond markets have priced in earlier before rate cut cycles turns, by around 6 to 9 months earlier. Hence, we find it right timing for investors to overweight bonds based on the current phase of policy rate cycle. Overly cautious investors will find it too late to buy bonds only when policy rate cut starts. As bond market would have reacted positively, it is now favorable to buy bonds at higher attractive yields to lock in future returns as yield go lower. We recommend investors to buy and hold to maturity selective investment grade bonds of up to 10 years tenor. We also recommend investors to buy quality ultra long tenor government and quasi-government bonds with tenor of around 30 years and hold these bonds for 1 to 2 years to benefit from lower yield curve. Investors shouldn't wait and hope to buy at the lowest price, as it is unlikely to perfectly time the market due to limited supply and lack of sellers on these bonds when bond market actually hit bottom. To capture bond investment opportunities, we have selected some quality bonds that are attractive. Kindly contact your relationship manager for more details on these bonds. With that, thank you for tuning in to our Digital Investment Talk.